Hey there, everyone. So this week we're discussing retirement, which is one of my favorite subjects. I am in my 30s, but I've been planning for my retirement ever since I was in my early 20s. And I actually bore my wife to tears talking about retirement. so, so anyway, I'll use this video as an outlet, which will benefit her because she won't have to hear this information when I get home tonight. So she thanks you for listening. I'd like to first just discuss what the difference is between different retirement investment strategies, different retirement accounts. So, for example, most people, traditionally people have like a pension. Usually, people that work for the government have a pension. My dad, he worked for the government. He's retired now. He had a pension called civil service, and a pension is essentially just a steady flow of cash that a business gives you as a benefit of working for them and retiring with them. So, for example, if you work for like the Missouri School District, you have a pension where you will receive, I think it's, and don't quote me on this, but I think it's 70% of the average of your last 3 years, or either your highest 3 years of payments of how much you earned in salary. So if you earned an average of $90,000 in your best 3 years as a teacher, then you'll earn 70% of that money each year for the rest of your life in retirement. So that's how a pension works. Here's the problem with the pension, in my opinion, is a pension is listed on the assets section of a balance sheet of the company or that organization that you retire from. So, for example, if you retire from, say, a construction company that gives you a pension and you're relying solely on that pension for retirement, and that construction company goes bankrupt, then your pension is actually up for that bankruptcy. So it can be liquidated and restructured to how it is paid for you. So you could get paid less in retirement than what you had planned for, only because that company screwed it up. So essentially, that is the ultimate way of putting all your eggs in one basket, is to go through a pension for a company. We witnessed this actually in 2008 when GM, a lot of the factory workers that worked for them had great retirements, and they had a pension through General Motors, which was their great retirement. And with General Motors going through all the financial restructuring they did in 2008, with the government getting involved with them and everything, they restructured how that pension was paid out to them, and they a lot of them got less money in retirement than what they had planned for, which was kind of a bummer. And so, therefore, there's nothing wrong with pensions. I just strongly encourage you to have other things going for you in planning for retirement. I think pensions are great. They're a great tool to invest in, like the military retirement. That's a great retirement program. Just do not rely solely on that retirement. You need to have other tools. So what other tools are out there? So you have what you would call you have a traditional IRA. Okay, so this is called an individual retirement account. It's an IRA. And so let me write some of this stuff down for you guys. So you have a traditional IRA. Okay, so there it's individual retirement account. And what you do is you contribute to that pre-tax. Okay, so normally you get a paycheck from your employer, taxes are taken out, and then you get what's left over, right? So in this case, what would happen is you get your paycheck, you invest in your IRA, and then you get taxes taken out, and then you get what's left over. Okay, what's the benefit of that? What is the benefits of pre-tax contributions to an IRA? Well, you get what you call compound interest, and I have different videos in the thread discussions which discuss what compound interest is. So basically, it'll say you invest $100, you earn 5% interest. You get $105. So that year you reinvest that $5. So now you're earning the 5% interest on top of the $105, and whatever that amount is, then you tack that interest on to the next year, and then you earn interest off of that. And it actually escalates very quickly. Einstein called it the ninth wonder of the world, or the eighth wonder of the world, whatever it was they called it. He marveled at the mathematical power of compound interest. And so through compound interest, you can use that money that you would normally pay in taxes and use that to build up your retirement. And then you pay taxes on that income when you take it out. I think it's sometime in your 60s is when you have to take it. When you have to start taking that money out of your IRA for your retirement. So Now you have what you call a Roth IRA. Okay, it's right here. Roth IRA. Okay, Roth. Trying to point to it. Is the name of the is either a congressman or a senator who came up with this idea and put it in the law, or helped get the votes to put it in the law and wrote this law. And basically what it's saying is that you get, so it's kind of like, it's exactly like the IRA, except you get paid, you get taxes taken out, and then you contribute to the IRA. Okay, so you contribute with after-tax income. Now, what's the benefit of that? Well, you don't get the compound interest on the amount that you pay on taxes. However, when it comes to withdrawal it, okay, from the retirement, then you don't pay taxes on it. And so with that, whenever you retire, you don't have to worry about the taxes. You already paid them. You paid them whenever you made the contributions. So why would you do that? Well, in all likelihood, you're probably going to be in a higher tax bracket when you retire. And the reason why is you get older and wiser, you get more skills with you. And so you will be earning more money whenever you get older, or the government will increase the tax bracket because it has steadily increased throughout history. And so you go ahead, you get the taxes over with, you pay them now, and then you get to take them out, or you get to avoid paying taxes in retirement because you went ahead and you paid them early. Okay, so that's what you call the Roth IRA. Okay, so now you have what you call a 401k. Okay, a 401k. Now, what is a 401k? A 401k is just like an IRA, except you go through an employer. And that employer matches you. Okay, so for example, my first employer out of school, they matched me 33 cents on the dollar. Okay, so every dollar that I contributed to the 401k, okay, they contributed 33 cents to it. Okay, which was a 33% return on my money. You cannot beat that. So if you can get a match through your employer, take advantage of that. The stock market has averaged 12%. Since we came out of the Great Depression, since we went in the Great Depression, which is 1929. So 12% is really good. 33% is outstanding. Okay, so most employers are about that. Sometimes you get 5%, 50 cents on the dollar, which is a 50% return. It just really depends on what your employer is willing to do for you. And so therefore, you get so in my instance, when I got 33 cents on the dollar contributed up to 6% of my contributions, then I got that 33% return, but it was with pre-tax money, which was okay with me because I was getting 33% on my money. Okay, I'm willing to make that a contribute pre-tax and not take advantage of the Roth IRA because of the great return on the match. Okay, so 401k stands for Section 401 subsection K in the tax code, which allows employers to do this plan. Okay, so that's what that stands for. So a 401k is a Roth IRA is a traditional, just a plain IRA, okay, except you go through an employer and they do the match on it, okay? And if you do, say, $100 a month for, 30, 35 years, you're most likely going to be either a millionaire or close to a millionaire when you come to retirement, okay, based upon the past history of the stock market as of this recording. So if you have a pension available to you, that's great. If you don't panic. It's not a big deal. You can take advantage of these retirement tools, and you spread across growth stock mutual funds, which spreads across different companies, okay, throughout the United States economy. All right, so you're not putting all your eggs in one basket. Okay, it's just the 401k is not a retirement investment. It's a tool to invest in different companies to fund your retirement. Okay, so if you do have the pension, still take advantage of these. Okay, if you don't have a pension, like I don't have a pension, so take advantage of these. Okay, and I also talk about what mutual funds to invest in the thread discussions, and I can review those in a later video. So if you have any questions about this, feel free to send me an email, even if it's after the class ends. One of my passions is to help people to retire financially secure. So hit me up with questions. I'll talk to you all day long with it, and it's less amount of time that my wife has to listen to me talk about this stuff. So she'll thank you as well. So, all right, hope that helps everybody.